Welcome, ladies and gentlemen, to a Grey Market Talk special issue. We have the doctor in the house, our friend Tim, the brains from the United States, and my old fellow, well, how do you call it, battle axe, Nic, who has been in the market for, what is it now, 75 years, something like that, Nic? Yeah,
At least.
you know, the Reichsbank and all this stuff. Anyway, so there's a lot of experience around the table, and in my modest role as the market hooligan, I'm obviously interested what we are coming up with. And Nic has put not Nic, Tim has put a lot of work into the CPI modeling again. What's inflation gonna do? And I had that conversation in the green room just to prime a little bit. Everybody is talking about CPI, and everybody I listen to says, well, we don't trust the numbers anyway. First of all, the majority of the housing equivalent is too big with 30%, and the rest is unreliable. But they always converge then to the conclusion, what you're going to do. That's what the Fed is going to look at, and that's how they're going to make their decisions. And in the past, Tim's models actually worked very well, I have to say, not just because it's part of our gang, but it gives a professional touch to the analysis, how to approach this, especially if we have historical timelines in there. And Nic went through all the effort again and prepared. When was our last meeting, Nic? Tim, in November, right?
Yeah. I think
So
the Grey Market Talk on November 19. And then we had a German edition, I think, first week of December.
Yeah. So I think that's what we're going to do again, because we had a little shouting match before and in the green room. Are we going to do it in English or are we going to do it in German? And we ended up that the English fraction won because Nic is still claiming that he doesn't speak German, which he does fluently, by the bloody way. But as it is running under the Grey Market Talk, we'll do it in English, and Tim and I will shoot soon another version in German to give that to our German audience. So, do I have anything else to say before I hand over to you, Tim? No, not really, right?
No, it sounds great. I will only ask you to cover the risk disclaimer.
Oh yes, of course. I'd love to do that.
I know.
You want to put the presentation up? I think I've already enabled screen sharing.
There we go.
Yeah, there we go.
So welcome everyone to this edition of our inflation analysis update in May 2024. There will be another one coming up end of the year. And what we are going to do today, I will show you after Torsten.
Oh, yes.
Risk disclaimer.
Evil risk disclaimer. Everything we are talking about today is just for informational and research purposes and shall not be interpreted in any way, mean or form as trading recommendations. We, Tim, Nic, and I, and the whole team do not take any responsibility of any buttons you might press after you heard this presentation. If you agree that it's for these purposes only, we're happy if you enjoy the next 3.5 hours of our conversation. If you think this might be trading recommendations, please switch off now. I think I've done my duty and we are clear.
Perfect. Okay, so what we are going to do now is first I want to give a recap, a summary of the last inflation analysis report from November, December 2023. Then we have a look at what happened since then. Afterwards, I will give an update on the correlation analysis. Some of that is an update on how what I did in the past, but I also did it for some new factors, which are very interesting and have been discussed as also drivers for inflation. And then at the end, of course, we do a little summary and give an outlook and actually try to come up with our own conclusions, how we actually use this information for the future, how we want to position ourselves and what we might have to expect. All right, to start all of that. For the recap of the last inflation analysis, I will give a general outlook, what have been discussed there, then go over the main conclusions from the correlation analysis I did then, and then also discuss very briefly the November estimate that I calculated then. All right, so this is one of the charts I generated, and the pattern, what you see here, is very well explained in our previous videos, and we will link that you can have a closer look, because we don't have the time to discuss this always in detail. So this was the stand of the consumer price inflation situation in November last year. So when you look at the end of the curve, let me actually get to the laser pointer, right? So when we actually look at, so we got this number. This was the October number, which is reported November, so that makes sense. And we saw a very high last year number in the gray bar, the month-on-month CPI. And when the blue is always smaller than the gray, that means like we will drift down. If it's the opposite, then of course we are ticking up. And after discussing that inflation was coming down gradually and checking out the future, so I pointed out that this area beginning of 2024 might be very decisive and that we can make a lot of progress actually here, because you see very high gray bars, which means very high previous year numbers that then compete with the new releases. And as I said, when we get like smaller bars here in red, then we make a lot of progress on the year-on-year inflation number, which is very important to the Fed, of course. So when we look at that, if we really like make a lot of progress, this should be very beneficial to where indices and where equities trade. And so that means beginning of 2024, I was pointing out that there's like a high potential for significant market moves, given these like high previous year numbers. And if we don't see any kind of inflationary shocks in like, for example, energy, that we could actually like move towards in the first half, so end of Q2, pretty much what we have right now. If everything goes like exceptionally well, we could move towards 2.5. And this would then mean a lot of like rate cut expectation, maybe a first rate cut already or two, maybe. And so it was like very like a very great outlook that we what could have happened. And then another big conclusion from last year's report was also when I had a look at the correlation between the PPI and the CPI, as you can watch it again in our previous video. So when we use the year-over-year numbers and correlate them with each other, we saw that the last data points that we got for the last about 2 years from beginning of 2022, they are all like above, like shifted from this regression line that was generated or fitted to all the data points, which means that we have a higher intercept than the actually the regression line here, which can be understood as a systematic factor that goes into the CPI by the PPI. And this is here for the PPI all commodities, which is not seasonally adjusted. However, the CPI is actually seasonally adjusted. So that's why I also did this this regression analysis for the PPI, not the PPI all commodities. And you can see here on the R square, so here we have 0.72. If you do this for the PPI, we reach 0.91. So this is like the best fit that we could get. And again, the lag is here like 1 month. So the previous compounded, so the year over year, you can say with 1 month lag in effect to the CPI year over year is displayed here with a very great fit, to be honest. The errors that we see here are still like along the data points with the regression line are still compared to what matters for the CPI and numbers like pretty like too high. So we have probably like a deviation of like 0.2, 0.3, which is a huge difference for the CPI, as we know. So even though the fit is very good, it doesn't mean that that this is a golden goose sitting on a holy grail. But it's the best way that we can do and actually helps us with more qualitatively estimating what will happen and gives us by that already indications what we can expect. All right, so yeah, you have definitely some additional factors that goes into the CPI from the PPI that like are secondary factors, like for example the cost of debt that needs then to get put on consumer prices, also transportation and any kind of services regarding the distribution of goods, for example. I also did then, so maybe just one step back. What I did here was taking all the data points that are available based on the PPI, which has a shorter history than the PPI all commodities. And I started here from 2011 and then considering all data points up till October 2023. It's from last year's plot. But then I checked also in the last report, I introduced the window analysis. So the rolling window analysis to not always only taking all data points, but also like taking, for example, only 1 year windows and just moving it and see how the fit then develops like over while shifting these windows. Again, please watch the section from the last video. It's I've like some nice animations there that will explain it very well to you what was happening or what I did there. So, and when we have a look at the window analysis, so these are the charts I had for each. So first of all, this is a window with 12 months. Here's the window 16 months, which means 5 years. And you see all the data points plotted in these charts for the slope, the intercept, then the R square, so the quality of the fit of the linear regression, and then some other R squares for some other matrices that I don't explain here because we have it in the previous video. And what I want to point out here is, what I want to point out here is the intercept. So we see here like this higher intercept, which is like you can say in the 12 months, it's a faster moving analysis than here, for example, the 60 month. Here we are just like increasing. Here you can already see we have reached the peak, then now plateauing. And this is exactly what we see in these PPI or like the PPI all commodities data points from the previous years. We see this higher intercept. We actually have the same slope, but we have a higher intercept, which means there are some additional costs coming from the PPI or some additional factors from the PPI on the CPI that actually like keeps us sticky up there. And I think it needs to be there needs to be some more work to really like figuring out what it actually is. Is it like just a cycle of the increasing costs of like the employment costs? Is it some like transportation or the goods in general, because we have some more regulation and some wars happening that actually hinders efficient supply chains. So which then makes it necessary that the producers put some more pressure on the CPI, so the price for the consumer. So this was a great learning from actually doing the window analysis. And also like in general, we saw that this is not only applicable when you take all data points, as you see here for the 60 month. There's some other like windows in the previous report up to, I think, 10 years, so 120 months, I believe. And so we see on the fit of the linear regression that we actually get a good fit. So this is actually like a valid analysis. All right. Then finally, I had a last report based on the regressions I did. I calculated an estimate for the CPI in November with about 2.9 year over year. 3.1 was then reported. So we didn't hit it quite well, but at least we were quite close with our analysis. I mentioned there different or like the reasons for that. We still have some errors here in around the regression line that has about like 0.2, 0.3, 0.5. So we were pretty close here with our estimate. And I mean, somebody could also say, hey, I was just a little bit too fast because in January 2024, we actually had an expected year-over-year CPI number of 2.9, which then was again reported at 3.1. So this is pretty much summarizing the previous analysis. Any questions from you guys? Well, so far, all good.
All good. We talked about the reason for the the PPI driving the intercept higher. I remember as well, and I think I took a stab at the producers are just profiteering from from what's going on, this whole inflationary thing, and passing on extra costs to the consumer. We discussed at the time whether that's the truth or not. We'll never know, or we may know later. Certainly don't know yet now.
I think we would have to like take some producers or like some companies in the or like just a broad screen of all the big companies and have a look at the margin. I guess it's a ton of work, because if they would just be beneficiaries of this like inflation talk and just like putting on prices, we should actually see that their margin increases, right?
Well, that's one of the surprises that's being discussed at the moment. Nobody actually really expected that all the big companies were able to really roll down the cost for production to the consumers. They haven't done so in the past. They always had to shoulder a larger chunk of it than they did at recent times. It really is, at the moment, if you can trust what is being portrayed in the media, that all the big companies are actually passing it on one-to-one to the consumer out there. That is an explanation for the points we are seeing here, right?
Or more.
Or more.
There was a one-off thing at the beginning, and then it's one for one.
Well, you just have to go to the examples I like to do. Tim, you're living in California. That normal families actually can almost not afford to go McDonald's anymore because the prices are really being rolled down to the consumer.
Oh yeah, I also saw this yesterday from the Maverick of Wall Street. He also did the fast food analysis.
Yeah, and I think
it's actually pretty shocking.
Yeah, well, it always nails on the head. There was this example that a Big Mac menu was something like $5 or $6 just short 10, 15 years ago. And now you pay almost $17 or something like that. Well, think about that. You want to take the whole family of 4 to McDonald's and you end up shelling out $100. Who can afford that?
Well, I mean, it's not quite that bad in Frankfurt, but I definitely know that the price of kebabs have gone up substantially. They used to be really damn cheap, and the queues used to be a mile long. Now, there's hardly people turn up to this thing, and I think the prices are up 60 or 70%. I mean, I don't believe that the contents of a falafel have gone up or kebab have gone up that much. But certainly there's been some these one-off. Take advantage, make as much as you can, but I think that's kind of backfiring now.
Well, when I studied in West Berlin, as an example, and I remember a doner kebab, of which I had quite a lot, was 3 Mark 50, 175 in euros at the time. Now the local doner kebab shop here around the corner on the countryside is asking for 8 euros for a doner kebab.
Same here, and it used to be before this whole lockdown stuff. It was 4.50.
Yep.
All right. So I've already pointed out that numbers were a little bit higher here than we expected it. So actually, let's have a look what actually happened since our last report. So first we have a look at also the market performance. So what was actually happening, and with equity prices, and then also we will have a look at the progression of the rate cut expectations, which is, as we know, driving equities a lot. Oh, I actually flipped that. So I just surprised myself. So what we see here is one of the capabilities of the Fed Watch tool. We see here the historic development of the rate cut, or like the interest rate expectations. So this chart starts in December 2023, and you see the time scale on the x-axis that's going to today, or like Friday last year, because I prepared the slides on the weekend. And we see different colors. Different colors stand for different interest rate regimes. So we have low rates, which are at the top. So we start from like 300 to 325 basis point. This is like the kind of red brownish color. You see here some areas on the very top, and then it goes gradually down to like the high rate regime here in gray, which is where we are now at 2.25 to 5.25 to 5.50. So this direction by the colors, this means like increasing rates and less cut expectations. And how these let's say curves develop shows you if over time higher or lower rates are expected this is important, for end of this year. So when we then go down and see what was happening. So this was right after our last inflation analysis report in December. So here this chart starts from December 14. The last CPI number that we got was 0.1. It was slightly higher than expected, and this corresponds to a year-over-year year-over-year CPI number of 3.1. What the Fed is always looking at is a kind of a 3-month average annualized. So this is what you have here at the bottom. So taking the previous 2 CPI prints and annualizing the month-over-month number gives us an annualized value of 2.02. So exactly, the Fed always has to target at 2%. This is actually exactly what they wanted to see. So that's why we also got this like market reaction, as you all know, from end of last year, where especially the IWM like catapulted up. And you actually discussed it in the gray market talk back in that day, and a few months earlier, that the IWM, so the Russell 2000, so the small caps, are actually like very compressed and haven't picked up. And exactly that's what then happened, I think, in early to mid-November. All right, so what it actually means by the colors, I've marked here the 3 areas with the highest probability. And so, so we see here the yellow, when you check the vertical expansion, or the vertical size, so to say, or length, the vertical length of the yellow area at on December 14, 2023. We see that the yellow area makes 37%. So which means the market was pricing in 6 rate cuts on December 14 for 1 year later, December 2024, and with a probability of 37%. So then we also had 7 rate cuts with 26%, and 24 rate cuts, 24% was, or the expectation for 5 rate cuts was 24%. All right, so what happened after that? We got the next CPI number on January 11. Both the month-over-month and the year-over-year number were elevated, but still, based on the previous 2 month-over-month number, when you analyze that, the 3-month average, we go to 1.61. So you can see here that the rate cut expectation actually increased from December 14, and we also saw this in the market. So it was a great time for the markets at the beginning of the year. So here, 32% were expecting 7 rate cuts. This is an increase from 26, and from 37, slight increase for the probability of 6 rate cuts to 40%. So after that, you see some spikes here. So this was first retail sales on this day, came up very, very high. So we saw so this is exactly not beneficial for rate cut expectations, as well as you might remember the extreme number for non-farm, the non-farm employment, and the unemployment rate numbers that came out at it's like late January. And this was again like directly reflected in these expectations. And then finally, with the next CPI print, which was also elevated, both the month-over-month and or like higher than expected, month-over-month and the year-over-year number, there was another increase in, or like less expected cuts. Like a probability was increasing for keeping the rates higher. And when we have a look at the exact numbers now for the probability, so the market was pricing in kind of like an equal, like these are the highest, of course, percentages. So both are around 30% for now only 3 to 4 rate cuts. And we started here from 6 and 7. So, and also you can see clearly that the 3-month average annualized CPI was also like shooting up pretty much like crazy, almost doubled from January. Okay, keeping that going, next in March 12th, we saw another increase in the like a significant increase in the 3-month average. Here, the probabilities for the highest probabilities are still the same for 3 and 4 rate cuts. However, you see that the purple and the red is kind of evolving from February 13, which means there's a significant development of market expectations for actually less rate cuts than before. Then we have an FOMC statement. So you can see by the drop that this was seen as what was stated in this report was then beneficial to expecting, like to keeping the expectations kind of the same as from March, after you saw another spike moving up. So you could say that, like, the statement was calming down the market regarding the diminishing number of rate cuts expected. Okay, keeping that going. So we got another like high and very hot inflation report. You see this development of the 3-month average annualized number is like, it's pretty crazy. What we saw here. So going back to what I showed in the recap, we didn't make this progress. It's very obvious. So the progress in the first quarter or quarter and a half in 2024 was actually not happening. And we have a short discussion in the following slide why this was happening. So looking at April 10 after the CPI report, we got like 34% and 34% for 1 or 2 rate cuts until December 18, 2024. Okay, so this was actually like going from like 6 or 7 rate cuts to 1 or 2. It's like extremely significant, right? And so we will check later also on the next slide, on one of the next slides, how the market reacted to that. But keeping that going, we then saw another increase from this level down to like end of April. But then we had like the FOMC, the jobs numbers, non-farm and unemployment rate, which came a little beneficial, like showing them some slowdown in the economy. And that's why we saw like a huge drop here. The next in May, CPI numbers were like, this was pretty much 2 weeks ago. We saw the month over month as lower than expected. And the year over year, the same as before. So we kind of like stagnating at this point. We still see like a slightly reduction in expectations for 1 rate cut and a higher and slightly higher number for 2 rate cuts here. And this was on Friday. And so we are again, so from mid of May to end of May, we saw like a significant increase for the expectation for only 1 rate cut. And the later we actually get to the election time, the less probable it is that we get a rate cut before that, because the Fed wants to stay like neutral and non-affecting the election time. So this is another thing that we have to keep in mind, and has also been discussed by Simone Bianco, as I think this Thorsten and Nick discussed in a gray market talk some weeks ago.
Oh, Jim Bianco, yeah.
Jim,
it's
yeah.
What I can see here, sorry to interrupt you, but it's this, the market was pricing in 6 to 7 rate cuts at the beginning of the year. Now we have all-time highs yet again, and this is completely out of the window, yeah? The most optimistic is like, 1 rate cut till December.
Yeah, I think there's always money to invest at the beginning of the year, right? So you have to put it somewhere.
Yeah, but the other thing you can see from this slide, by the way, I mean, it really wouldn't surprise me if this slide goes viral somehow, because it's a really good slide. What it also shows you is that FOMC in March and FOMC in April, these guys want to cut. You know, they talk the market down. You know, they're saying, calm down, guys. You know, we know about these hot prints and stuff like that. We want to cut. You know, twice the FOMC have tried to calm the market down, and of course, then after the FOMC, they go back to selling, you know, the Treasury market, and we'll see when the next one comes.
Well, I think personally, they also don't want to like run the economy down right in an election year. So it's difficult. I was also because there's also talk by, or like I think Lynn Alden made this like was discussing, at least I don't know if she was the first one that come up with this topic, or like creating the awareness for this, but fiscal dominance. So given the cost of that for the US in general, so increasing rates now like puts even more pressure on it. And so but however, if the government keeps spending, they actually have more control over the interest rates and what's happening with the interest rates than the Fed itself. So this is like was very interesting for me to listen to this topic explained by Lynn Alden about the fiscal dominance in the game of interest rates. Good. So let's keep going. What were the reasons that we saw for this like higher or moving up inflation. So this is a great chart I found from XTB Research that was showing, or that is showing the January CPI contributions. And you see here shelter and energy with the highest contributions. Unfortunately, I didn't find similar plots for the next months or like for the following months. I like this chart a lot, so I think I have to like write another like code to actually download the data from the BLS and write some additional scripts to generate me these plots, because I like them a lot, and would show us what are the individual contributions for the CPI like month by month. That would be extremely helpful for discussing what is currently or what has been driving. So anyways, we see here beginning of the year, it was shelter. It was also discussed in some headlines. After that, I found some other 2 headlines by Google search very quick. So that actually pointing out that energy costs, or electricity and gasoline costs, are pushing actually inflation higher. So it's all about the energy, which I was pointing out in the previous report, that if you don't see inflationary events, especially in the energy sector, that we should make this progress towards like 2.5% CPI year over year, but we didn't. And this is actually summing up in one slide why. Pretty much shelter at the beginning and then energy. So then, however, how did the market react since then, since our last report? So we see here the indices. So we have the Qs here in light blue, SPY in orange, IWN in yellow, the Dow Jones in blue, the TLT in red. Then we have the Max 7, and of course, everybody's talking about it, NVIDIA. This is actually from yesterday, because NVIDIA was spiking up again from end of last week to now. So that's why I updated the chart like last night. And so you can see here that the indices actually made a good performance. So if you were just invested in the indices, or even like, I mean, you made a killing if you were just like a small selection of big caps, if you're invested in them. And so it actually looks good. You don't see like the reduced expectations for rate cuts here, which is kind of surprising. You see the TLT like under pressure. Really you can see like there was no, I mean, after a starting progression in the TLT, we're actually down since November.
It's again, I remember we had one of these slides on one of our gray market talks actually to the analysis, what the analysts were expecting for the future, and it was clearly not what was happening on the TLT. Yeah? So you had it just in the slide beforehand, Tim. 7 rate expectations on average. Yeah, imagine if that would have really happened. Where should the TLT have been if that came in? I'm just surprised about the equity market's performance with these reduced expectations for rate cuts. That's the thing that does absolutely not fit into the picture.
Yeah, I mean, it's probably a separate topic, but it's linked. Yields in the market do reflect growth, nominal GDP. So, the higher growth is, the higher yields are, and, the higher the growth, the higher the stock market. It's only been, a certain period of our history where we've been used to this negative correlation, where the only time you buy stocks is when interest rates go down. But remember, when interest rates were going down, the economy wasn't in such great shakes. So, I mean, the economy is in much better shape than it was before. And this correlation of yields and stocks is the other way for that reason. Now, there does come a point with this valuation story, which is the separate topic, where valuations and very high valuations and very high interest rates aren't going to last for too long together. So valuations do have to come back into line. But generally, higher interest rates is firstly a sign of a strong economy, and that's good for the equity markets. And as I say, there are different regimes where low interest rates were the driver, but as you can see, we are going to the moon with 5% interest rates. We were not going to the moon with interest rates at 0.
Yeah, this is something that Thorsten always reminds us. If you have high inflation, you have to have assets because they become inflated too, right?
Yeah, well, it depends on, yeah. Normal inflation is a bitch because, well, you will have higher interest rates and you can put your money into the safe, air quotes, bond market and should be all right. But if people sniff around, and we discussed that in length, or Jeffrey Gundlach actually started that Pandora's box with saying, okay, if interest rates stay at this level, how much does the government, the fiscal dominant part, has to actually pay out? If people sniff out that a currency is actually just a promise and printed on paper, and nobody's actually ever going to repay it at the purchasing power it once have. We have the explanation for the gold market as well at the moment, we can see in here. Yeah? And if that is the case, then all negativity on my side, yeah, trusting in traditional models, high interest rates should actually not be beneficial to high-tech stocks. That's completely out of the window. Then you actually have to readjust your mindset and say, forget everything you read in economics books at university. Say, we are back at the period where the market sniffs out it's better to have, again, air quoting it, brick and mortar. And brick and mortar in that case would be equities.
Yeah, absolutely. I mean, I think this sort of higher inflation environment, does mean you need to think about what stocks you have on your books. But there is, at the same time, this whole tech, AI, I won't say revolution that's going on, but there's sort of new impetus for AI that's sort of the other angle that's kind of running alongside of what's going on with inflation and interest rates and everything else. And so it's kind of, people are saying everything in that respect is linked, but it's not. I mean, I think these are separate stories that are kind of happening concurrently right now. And we mustn't forget that there's a lot of money that's been invested in this whole AI story, and that's kind of driving, in addition, an extra growth, an extra impetus for technology stocks. But you have to see something come out of that. In the meantime, the real economy is kind of doing its own thing.
Yeah, it's what went through my mind is this. If we talked about it earlier, if companies, the big companies with the desirable products, are able to put on their costs to the customer, that's exactly the sector you want to be in then, in a high inflation environment. They are not suffering. They're passing on to the customer. They still have to buy the prices. And then you have the Mag 7 on here. But we're all following. Tesla is reducing prices on their car almost every month, right? That is actually not somebody who's passing on the prices. The reverse is true. I'm totally with you with the AI story. It's still on, but all my colleagues know that I'm having a mental breakdown. I'm trying to ask ChatGPT something to explain some rather or medium complicated math bit to me. And it actually, first of all, it lies. Then I ask it again. Then I thought I almost broke ChatGPT because it's repeating and repeating and repeating. And then I call Daniel, one of our guys in Berlin, who is a very bright chap. And there's one bright chap, and there's ChatGPT with 1 million data centers. I'm exaggerating now, engineers who are programming this. And Daniel knows more than ChatGPT to explain it to me. So how smart is that stuff really? I don't know.
And that's what I say, we need to see something coming out of this thing. But the value of something like NVIDIA is expecting a quadrupling, I think, if, maybe that's not the right number, but quadrupling in revenues or earnings over the next 5 years. I mean, it's huge. So they have to come up with these numbers and have to make sense of them and have to sort of match what's being expected. We'll see whether that's the case, but definitely when you read the analysis of all of the earnings reports, almost like a few years ago, every company was saying, we're getting into blockchain. Now every company is saying we're getting into AI, and of course everyone's spending a hell of a load of money on AI as a company, and we must not forget that everyone spending that money with NVIDIA. But when Meta were spending too much money with NVIDIA, they absolutely killed the stock because they said, well, hang on a minute, you're spending too much money on AI for next year. That's going to kill your earnings. Have you got something? Have you got a product or anything? So, it is a double-edged sword right now because NVIDIA is benefiting from the hype. but the companies who are buying the products have to have something to justify the CapEx spend.
It still reminds me around the year 2000. First, we had the internet, and then people had to come up with ideas to monetize it.
Yeah, that's the thing.
That worked fantastically. But now we are at the AI stage. Yes, it's fantastic. It's great if and when it works. But people have to come up now with business models to actually derive money out of the whole AI thing. I just had this experience. Zoom is changing their layout all the time. Suddenly, an AI assistant popped up. But where I used to find the button to check the scheduled meetings, I had to start searching again. I hate doing that. Yeah, and I haven't used the AI companion because I really don't know what purpose it has.
Indeed. As I say, you know, people like Meta have to show what they're going to do with this AI. And, you know, that's... But in the meantime, everyone's spending still a lot of money with NVIDIA. And, you know, well done, NVIDIA, for succeeding.
Yeah, absolutely.
All right. Besides NVIDIA, how is the broad market doing, right? So this is showing the indices for like the indicators for how many stocks are in the S&P 500 and in the Russell above their 200-day average or above their 50-day average. And you can see here we are pretty much for the Russell 200-day, 50-day, and the S&P 500 50-day. We are pretty much in the middle, around like 50. So this is, it gives you an indication that, okay, it's not only besides the Max 7, everybody is not, so every stock else is not just like plummeting or something like that, and only the Max 7 is holding up. They are doing pretty okay. You only see that the number of stocks in the S&P 500 that are above their 200-day average is like at about 70, 71, which is like at the higher end of this area. Pretty much showing, okay, besides the Max 7, we see that the other stocks are doing kind of okay. If we have a look at new highs and new lows, like new 52-week highs and new 52 days lows, which is shown here in green, the highs, and the lows in red. So again, how many stocks are making new lows and new highs? That is shown here for the New York Stock Exchange. So when we only see at like green and red how they are in relation to each other, we see we actually like doing pretty good. Also, we don't see that highs are plummeting and lows are spiking up, as we see here at these like spikes. We see, of course, like this area around 2021 where we got a lot of money infusion and then driving the stock market, as we know, to extreme acceleration. Okay, good. So this is just showing you where we are like in the broader market. So again, so now I want to come up or come to the an update on the CPI correlation analysis. First, I'm giving an update on the PPI correlation based on the previous report and compare the results that we now have with the previous ones. And then I will show you new correlation results for the FCI-G, which is the financial conditions impact on growth index by the Fed. It was like recently introduced. I have a small section about that, going a little bit more into explanations in our last report. Then the M2 money supply, oil in general, and then also like having a look how commodities will correlate or are correlating with the CPI. So I'm doing this. So first, when we have a look here, so left was the last report from November, December 2023. On the right side, we see the current fit. The points in red are the last 28 numbers, which means from January 2022. When we have a look at the fit, the R square is kind of the same, around like 0.91, 0.88. And we are still elevated above the regression line in black. The last numbers were kind of like in this regime here. So we are, you could say, after these higher or like more shifted data points from the regression, we are kind of like slowly getting lower. So we are going the right direction. However, we are still stalling. And So this is pretty much an update on that. There's not so much to say. We are still elevated and slowly coming towards the regression line, but it takes a long time, as we see here. When we then have a look at the here I'm taking the PPI all commodities to just give you more history, because the PPI itself from the BLS is reported since around end of 2009, 2010. So that's why I don't have that much history. So with the year-over-year compounding, I can around and like a lag of 3, I can kind of start at like February 2011. However, with the PPI all commodities, which is not seasonally adjusted, which is a drawback when you plot this against the seasonally adjusted CPI numbers, you can have more history. And this is showing here. So this is like a plot from 2011, from 1990 and 1949. So this is like the longest history that we get. And we still see, as in the previous report, we are elevated, and this has also been not new in general. However, against the long-term average, we are still like higher with these data points. So it's clearly showing we are working in a different regime, which is not completely new, but still like elevated compared to the past, or like as long, or taking the average into account given by the regression line. Yeah, what we see here, what I was pointing out by having the previous report numbers, so the fits down here compared to the new numbers that we have with the current data points, so half a year later, is when we have a look at the intercept. So having more data points above this regression line, or like in this higher regime, of course, gives us a slight increase in the intercept. So here from 1.95 to 2.04. And you see the same effect for the other data ranges. So 2.13, 2.17, 2.24 to 2.26. So this is what you would expect, getting higher data points in an upper regime. And so this is kind of like also showing the stickiness of these secondary effects on the CPI that we were just discussing. When we now actually check, we know that PPI and CPI was working well. So I've also done this for the PPI on PCE. And we see another great fit. So the R square is about the same, around 8.8 or like about 0.88 or 0.87. And so it means we can also use the PPI reports for kind of like predicting or getting some estimates for the PCE. So it is actually great. So we can expand it from CPI to also PCE. The lag here is again to make this comparable 1 month, and also has the same history or the data range.
Which is also, by the way, coming in tomorrow at 2:30.
Yeah, correct.
German time.
And I have, and to give like a little, so stay tuned at the very end of the slide deck, or the presentation, I have estimates. So you can then also like rip us apart in the comments, or just applaud us for the great estimate that we are coming up with. So we'll be really interesting to have this.
Haven't you learned anything? Never make forecasts before the figures are coming out. Always do it after. Far more reliable.
Yeah, but the problem is I'm not a financial analyst who is like whose kind of job description does it. It includes always make adjustment after the reports, and make adjustment to the forecast of stock price after the financial statements. All right, so yeah, it is great. It also works for PC. That's pretty much the main message here, and we also see the elevated regime here, but also like we are slowly coming down, but it just takes longer than expected. Okay, good. And then this is like an update on the window analysis I did. This is for PPI, and I was actually like discussing earlier when we look at the intercept that we were elevated and plateauing here in the like faster moving 12-month rolling regression analysis results. And when we look at the update we see here, so we were like kind of slowly coming down a little bit, but still plateauing. So this is another evidence that it's sticky. It is really sticky, what we see here. When we have a look at the kind of like shaded area here for the slope, we are kind of, again, along the long-term average that is here seen by the dotted red line. So the slope is not a problem. It's really the intercept, like the basis effect that keeps this whole hot inflation going and sticky.
Well, we had it earlier. It's
Okay.
the McDonald's indicator, right? If they're passing it on 1-to-1, it sticks.
Yeah, it's a question. What will end this, right? Will it be the consumer that's like really like maxed out? Everybody has 15 credit cards, and even their dog has 5 credit cards. Everything's maxed out, and they finally stop spending.
It's always an external shock. Recessions are never just developing into a recession. Everybody saw it coming. It's always this one big bang that comes in. Yeah?
And then everybody wants to go for the
exactly,
same floor, right?
Exactly. And we haven't had that yet. Yeah, that's the situation we're all waiting for. I don't know what happens in the Middle East. We don't know what happens in Ukraine. It's probably something completely coming out of left field. For a moment, I thought it's the Bank of Japan who's doing shenanigans, and the move might be coming out of this direction. I really can't tell you. Maybe it's the election that, I don't know. Everybody's waiting for November, and then in November it happens. Trump gets all 50 states. Something like that. No discussion about it. Yeah, what's going to happen then? Or Biden gets all 50 states and people start scratching their heads how that's possible even.
Yeah, I mean, we are just like to make the statement. Maybe we are pretty much discussing.
The jury in New York is deliberating at the moment as we speak. Sure. Yeah, maybe they're arresting Trump tomorrow on the floor, and that will give some minor market corrections.
I mean, it's worth mentioning that we are just discussing that with hindsight about what happened in the past, right? Nobody is like extremely interested to see like a big recession because we know what kind of economic and personal effects it has for the general people, right? It's just like, I mean, if we would find another solution for that, it would be great, right? But
it's not going to happen. When you look at these statistics, the longer the yield curve stayed inverted, the bigger was the stock market correction after that. And now we are in top territory, right? With yield curve inversion. Or have we seen any longer before in the past? In the 70s, maybe, right?
You know, I think this yield curve thing is really is a bit of a ruse, and it is a bit sort of over-focused, and a lot of people have paid an awful lot in looking at that as an indicator.
Oh, Nic, is it different this time, Nic?
No, I'd say it's been the same as before. In other words, it's an awful bloody indicator.
Yep.
And you've got to sort of break it down, and you know, I'd say there are reasons that you have lower yields in the 10-year, and there are reasons that you've got very high yields in the short end. And it's nothing to do with recession.
No, I'm almost with you. Yeah, I'm a big fan of the leading indicators, and all the traditional models seem to be broken at the moment.
You know, when you throw a lot of money to the system, you can hide a lot of sins, and that's exactly what's been going on. And you know, you talked about fiscal dominance. We spoke about it in our very first video about, you know, they will not let the market go. The Fed put is by definition, you know, all about keeping the market together, and high interest rates is something that is absolutely not sustainable. And you know, when you go back to that sort of that wonderful chart that you showed earlier, which is going to go viral, I'm sure, where the Fed have effectively twice in a row basically said, no, we want to cut, right? They said, and for a reason, they want to cut because it's just getting too expensive, and you know, for the government, and this interest rate that they're paying is money that is just printed and goes into the economy. So you're not going to, if you like, if your intention is to stem economic growth, firstly, you have to make sure that people were borrowing money in the first place in order to create that economic growth. They never were. This growth, if you like, came from money that was given to them by the government, printed by the Fed, and that's the reason for it. And I think they've kind of realized that right now, and that's why they want to keep a lid on interest rates. So yield curve wise, you know, I'm not really sure about it forecasting recessions. Coming back to the point You know, I'd say look at some other stuff right now. That's probably a better indicator to play.
Okay, speaking of indicators, so what can we actually do to continue the and expanding the investigation regarding what correlates with CPI, right? This is a question I took on, and in the following, I will discuss different factors, like here the FCI-G index, which actually comes out as baseline and as a 1-year look back. The baseline is actually like considering the last 3 years as having an effect on the current situation, and the 1-year look back is really just for the last 1 year. This is pretty much the difference between them. Again, there's a small section in our previous report with some links and some slight more explanations there. So please have a look. So in the following, when I discuss these different factors, this is how the slides will look like. I have a heat map here on the left side, on the middle of the chart, which has often 2 data regimes. So one is taking pretty much like the available history, the complete available history. So here in this case from December 1991, and then like a shorter term history since January 2012 to make this kind of comparable with the PPI that I had before. So you can see here, this is like based on pretty much summarizing the results of the window analysis I had before, and I had like also a data table in the previous report, and I'm taking the linear regression R-square values to create this heat map. So to walk you through one example, let's pick this one right here. So the 0.06 is pretty much the FCI-G index baseline monthly number versus the CPI month-over-month number with a lag of 0, which means the main number of the FCI-G index baseline month number will then be correlated with the CPI month-over-month over the whole available data from 1991. And if we increase these lag, this means like we take the April FCI-G number versus the CPI and have a look at then this correlation, which is 0.05. And I did this for the month versus like month-over-month versus month-over-month. The yearly number, which is here just in a summation, because it's not like a percentage change, it's just like just a number they came up with, which should actually already symbolize the impact. So they just aggregated that by summation. Then we have the, so this is like the yearly aggregate versus the month-over-month. Then from the factor that I'm discussing here, the FCI-G, the monthly number versus the year-over-year for the CPI, and then both year-over-year versus year-over-year. So pretty much I'm applying from top to bottom more smoothing to these kind of factors by compounding it to the year-over-year. This is pretty much what is happening on the left with these rows. Here I discussed the window. It's always like a delay by the factor to the CPI. And for the highest, or for the best fit in this case was when we look at T-2 and T-3, and I have a closer look into the plots. It was actually T-3, which is higher and has the highest R-square. And I have the respective plot here on the right for the regression, that you can get a feeling how that actually looks, just because just the R-square, okay, tells you 0.18, not useful, and this here actually shows you how it actually looks. And the same is then at the bottom for a shorter time span, since to make this comparable with the PPI. So to the conclusion from this FCI-G index impact on growth index by the Fed in the baseline form versus CPI is pretty much, okay, we cannot use it for a valuable conclusion to the CPI. This is pretty much what's behind all of these numbers that you see and behind the heat maps.
Okay.
When we then go on to the, oh, excuse me. I caught another deadly virus in New York last week. So, so then I already mentioned that the FCI-G index also has a 1-year look back, which should give you like a faster paced impact again. summary. You can make this short here. You can pause it and look through the heat maps and the plots. It's again not valuable, doesn't have a valuable implication to CPI other than pretty much that we shouldn't and can't use it. It's also, I have to admit, the FCI-G index is like more based on having an estimate or like kind of an influential estimate on the GPI, on GDP, on the whole like economic growth, not necessarily for CPI. But of course, it was interesting to take this new indicator by the Fed and to analyze that. So then, Nic, you asked me to have a look on the M2 money supply, which is shown in this slide. Unfortunately, I cannot like give you any kind of promising results here that gives a high correlation.
You've just destroyed the work of Milton Friedman, Steve Hanke, and all the monetarists. And I'm a monetarist myself, so as I say, I see the numbers. I saw the numbers when Thorsten showed me the presentation earlier, and I still maintain there must be possibly the regime start of January the 12th. Effectively, what you're, firstly, let's explain the numbers. The key number is the bottom table, bottom right, which says 0.45, which effectively says with a 12-month lag, there's a stronger correlation CPI and money supply, but with 0.45 R squared, there are probably better things to look at. And you might sort of flip over to the next slide and say, okay, nothing to see here. And in the words of Thorsten, this time is different. The regime post 2019, there's certainly been a lot of noise between 2012 and 2019, but from 2019 onwards, where we had the most extraordinary amount of money printing, and M2, the rate of change of M2 and M3 just exploded, then, there is a much, much stronger correlation than would otherwise be seen by blending the 2012 to 2024 data. In my view, I think that number would be a lot higher. But I take the point that over long periods of time, and you have to be really careful about, and I've looked at sort of studies from the ECB on money supply and and its influence on CPI. I mean, there is a reason why the Fed don't follow money supply, the ECB don't follow money supply, and the Bank of England don't follow money supply. And I think they're all stupid for not following money supply just after you've exploded the money supply, and then say, well, we've exploded this thing called money supply, we've chucked a lot of money into the system, but we're not going to focus on it. And I think that kind of behavior is a bit sort of irresponsible. But and I think the amount of money that came in post-COVID was just so large that if you narrow down the window from that time, you'll see just how much it does influence the inflation rate. And I showed Thorsten a chart earlier of how it is the lead, if you like, for inflation, both when it sort of started to pick up in 2020 and also again last year when it bottomed out, and that's the stickiness that you're seeing today in inflation. So I say that there is some caveat on that table here, and that is the new regime from 2019-20.
Yeah, exactly. You just already made the point that I wanted to briefly discuss taking the scatter plot here into consideration. So we have different regimes, right? And I also heard around 80% of the dollars like circulating were printed after 2019 or something like that. I mean, you just pointed out it was almost unimaginable amount of money that was printed there. And you can also see here, like, again, there are some data points like actually shifted from the regression line that we see here, right? And I didn't do a window analysis or marking the points, or like, are these maybe the last data points we got, right? Since 2021 or since then. So what I will do and provide you with is the window analysis, where I take like shorter time spans and like just apply this to all the data points, and then we see if there are like there are time regimes for these window analysis where we actually get a high fit. And I would actually like see already from seeing just these data points, I would expect that we could see something like that.
Yeah, I mean, as I said, I showed the like a trading view chart of CPI versus money supplied rate of change, and you know, you will be more convinced, if you like, in the argument that there is a new regime in play right now, and therefore very relevant for the Fed to try and other central banks to monitor, especially after you throw money into the system and say we're not going to look at money. I mean, it's kind of, you know, it's silly. But anyway, that's good that you're doing that. I think that's let's see what comes out.
But let's put it that way. A shift in regime actually is an explanation to explain all the idiosyncrasies we are seeing at the moment, right?
Yeah, and you know, we keep saying this time is different, and you know,
I'm just doing that to wind you up, Nick.
I mean, it is. I've said it a few times actually in our videos. This is a phenomenal thing that the central banks in the West predominantly did in the last few years, and we're in a new world.
Okay, let's continue then. So then I said I will have a look, or will show you the results against the oil. I took the WTI because it's the most important one for the US economy, and we're looking at the US CPI. So you can see here again, we get some impact, but it's the degree of the fit is not high, not you shouldn't really use it, and like the calculation you get out of that to take this like with a very high of certainty, of course, or like the or certainty that you will hit the CPI number. However, you actually see what you were expecting. Like if oil increases, it doesn't take very long to get this reflected into prices, right? Even though the fit here for month over month is 0.26 in the best case, you see it is like with a lag of T-1, and then it just drops to almost zero, right? So you can see here just by these differences that you get this like translation from oil prices into the CPI pretty fast. But again, the quality of the fit is not great. Then, however, when you have a look at how it actually like the WTI affects the PPI, which goes, this could actually make sense, right? Like transportation costs and in general, like energy costs for also the producers. We see a better fit. It's here, the best is around 0.6 with a lag of, you could say, okay, T-1 to T-3 or 4. So they're like, of course, different kind of producers, which are differently depending on oil price, and that's why it's like slower reflecting in the PPI when the price of oil increases. Again, you also see like the higher effect on PPI fast, and then it drops significantly. And you can see the fit on the right. So this is just like good to keep in mind. Again, you see here the higher data points here that kind of might reduce the quality of the fit a little bit. However, this is how the data points look like, and this is what you can take from it. And this is like just, let's say, confirming the like kind of common sense thinking that we had before.
So we're pretty much at the moment at the same levels like 6 months ago, which means impact zero.
You mean like the where WTI trades?
CL, I have the future on my screen right now.
Yeah. Oh yes. Yeah. I was actually happy seeing like that energy costs are coming down for the reasons that I will have at the conclusion slides. So, but to continue that, so from only looking at oil, I had a look at the commodities in itself, or like as a whole, and I was using here the Thomson Reuters commodities index. The ticker is up here. It's a longer one. Again, thanks to Marcus pointing out this index for me, or to us in general in our like group talks that we have every week. So what can we see here? We see like, of course, first of all, we actually see similar what we saw in oil, like a higher translation from increasing commodity prices month over month into the CPI. And we see down here, which again is since 2012, a pretty high, like a higher correlation than before of about like 0.74 in the R square values, which is the best from this analysis. Investigating different factors other than the PPI on the CPI. So commodities definitely play a role and have the highest impact on CPI. When we then go and actually have a look, how does the commodities affect the PPI? We actually improved this fit to about to the maximum of 0.87 with a lag of 1 month. The plot is here on the right. So which means we can then actually like better estimate how the PPI will develop the next month, based on looking at the commodities with a pretty good fit. Again, it's like I was surprised about like an R square of 0.87, which is which then results to a correlation coefficient of 0.93, and everything about 0.9 can be really considered as valuable for your analysis. So, and you can then see, okay, by this we can kind of get estimates how the PPI will develop, and we know that the PPI correlates with CPI of also about 0.9 at R square. So this gives us an indication how actually CPI will also move maybe 2 months from now. With like this just gives us another kind of factor to stack our probabilities in our that we are like estimating market moves or CPI moves correctly.
So we had the highest correlation at oil 6 months, right? And now at the commodities was PPI, we have 0.87 at 1 to 2 months.
Oh, for oil on PPI, you mean?
Yeah.
Okay, let's go back. Yeah, more like lack of 2 months-ish.
Oh, 2 months. So they are corresponding. Yeah. Okay, cool.
Yeah, it actually all makes sense. It's like it's you could say that even the fits are not perfect. I mean, it is like markets are very complex. So if you would get a fit, I mean, and we are also talking about a linear regression. We take the whole phase. It's not a window analysis. So it actually all makes sense, even though the fit are not perfect. But I mean, it would be like a miracle if that's already perfect, and we would have solved everything. So and then to have this like comprehensively, I also have the plot here for PPI versus CPI in this whole series. All have the same starting dates of January 2012, and this is summing up the results just comprehensively to the results I showed before. So the plot is about like 0.88 with a lag of 1 month. Gets when you look at the specific numbers, this is the highest of 0.884, and yeah, this is how the plot looks like to sum up this analysis and the heat map. So even though we have like these great plots and additional information from the commodities, it still makes our estimation for the next month a little difficult, which is just caused by the Fed, not the Fed, the BLS actually adjusting these numbers. You get the most adjustments from 1 month to the next month. Also, when you look into the reports, here's a link to that, and here's like on page 2, you have from the last report table A, and in the additional footnotes to this table, you see that the Fed actually, or not Fed, sorry, the BLS actually always has a window of 4 months where it adjusts these PPI values. I had a look after the first month adjustment. Usually the adjustments are not so high, but when you only look at month over month adjustment for the first time, you can see here when you have here look at the table that I found on investing.com. You can see here when we go from July last year to August, we saw a drop of minus 0.1. Actually, I don't have it here on the slide, just because you see every yellow dot is actually like an adjustment made. When we I considered the value before, it was also a drop of 10 basis points, minus 10 basis points, and it was actually increased by 10, and so on, as you can see here. So the last was actually extremely significant. I was just very surprised, but by such a high correction. So since all of the data points already have the adjusted numbers and don't take a potential adjustment into consideration, so this is kind of where deviations come from. Because we will work on a number that is not adjusted to make the estimate, and then with the next report, this number becomes adjusted, right? And so this is just like giving some more insights that around these adjustments which are actually made and can be made for the last 4 months. All right, so but what can we take in general, like to have a summary of what I've shown here in this section is, okay, we found out that the commodities have an impact on the PPI with a lag of 1 month with the highest R square. And we also know that the PPI affects with a lag of 1 month the CPI. So we can actually make these kind of still highly qualitative, but since the fit is actually pretty good, also kind of like certain estimations about how CPI will move. And again, a section of the heat map down here. And what you see then here is when we go along this chain, let's have a look at the commodity index. So this is like a monthly chart of this index, the Thomson Reuters core commodity index. And when we look at the last months, we see that commodity prices increased. So we can expect just that the PPI is like further under pressure, which will also like keep CPI higher, which is not what we would wish for, but this is the data. And actually what I did since these the data for the correlation analysis are actually coming from I got this from TradingView, and you have like daily data for this index. So what I did to avoid any kind of spikes and like month over month, because we only look at the last day of the month, right? So it could be a flat pretty much over month. If you have the last day, it spikes up, then you see this like big increase, which is actually not reflecting what was happening over the whole month. So what I did in the data preparation step, I was taking daily data of the CRB index and taking the median price level over the month, and was taking the medians for the regression analysis to actually avoid any kind of spikes or like taking spikes out of the analysis. So when we look at actually medians, I think I have it on the next slide, we then can see that we were pretty flat over May, which is kind of, I'm like just like very glad that we saw this, that we are not like accelerating further in the commodity prices, because as we see here, they have an effect on PPI. PPI then affects CPI with a high correlation. So, and then also what we saw end of last year, I have this like drawn in here. BB dropped by about 7.3% in this index from around October to end of December, which then explains why we got the development as we saw that late, like regarding the CPI inflation end of like in the last quarter of last year. So to sum this up, PPI seems to be more under pressure for the next 1 to 2 months. After that, if commodity prices stay at the same level as we have it now, the pressure on PPI should come down, and then as it should be for CPI.
Always not assuming that the whole talk about the commodity supercycle is not completely offsetting the medium to long-term predictions, right?
I mean, since I'm looking at month-over-month changes, right, there could be a super cycle. As long as the super cycle is rather slowly progressing over years or decades, it could be good. Markets could adjust. But of course, there might be long-term effects that then blows up this correlation, because we get into new regimes, as we discussed before.
Yeah.
That this then has a more significant impact on how economies work. All right, and then what do we do all of that? What conclusions can we pull out of the analysis that I've shown here and the updates for how markets might move and how we want to be positioned and what we should consider? So first, I just discussed the PPI that should be like a little bit more under pressure. And this is the same plot I have shown in the past, but now for the PPI. It works the same way as in the past. So gray bars are the previous year numbers for this month. The blue are the current ones. The red are some simulated numbers, and the green is the year-over-year rate. So based on what we have seen here, it is actually like simulated that we get like still like more or like rather compared to the next month or to the previous year month numbers that will follow, like higher PPI numbers, and then this will cause like the year-over-year number to increase, and so that brings us a little bit higher than the long-term average, which is here in the dotted white line. When we check this long-term average from 2009 on, and calculate the month-over-month average, we are at 0.14% of month-over-month PPI, which then gives an annualized number of 1.7%. However, I have it down here when we take all the years up to, not only up to end of 2019, but up to today into consideration, we see like an average annualized PPI of 2.58, which is actually shockingly higher. And this is like caused by this like ginormous spike up here, caused by all the money printing and the inflation that we saw starting from January 2021. So when we have then actually higher numbers in PPI, we can expect that CPI is not dropping fast. So this is the current plot with the expectations, some simulated progressions for the coming months. So we see we have like very low, or like at the lower end of the spectrum, month-over-month numbers from last year that are coming up for May, June, and July, until we get like a higher number for August, which is then of course always reported 1 month later, right? As we know. So when I talk to you about the next May number, this will be reported in I think in about 2 weeks. So this is very low, and given the last like the progression of this month-over-month CPI numbers, my expectation is that we really beat this last year month-over-month CPI report number, which then drives up the year-over-year rate. This won't be taken, let's say, nicely by the market. This is my expectation. We could see volatility increasing again with this report, and then also the following months were pretty low. So we might like grind up a little bit and stay on plateauing there. This would be the best case if we're getting higher numbers here. Okay, we will rise even further than the around 3.6 that I have here, maybe a 3.7, maybe 3.8, when we really beat these the next 3 prints for the CPI month-over-month. And there's also like the discussion is always CPI. The Fed wants to see CPI at 2% or moving towards 2%. I was actually wondering why 2%. So I calculated the long-term average, which again from 1990 to 2009 is 2.4%. If we take like the high inflation regime into consideration that we saw the last years, this is actually like 2.7%. So like really the question, why do you want to push it down to 2%? That we inevitably actually cause like a real like recession in the market when they really push the economy down to 2%. This is my conclusion from actually calculating the month-over-month average and then annualizing it. So yeah, so it will be a hot phase the next 3 months, and we need to be aware of that.
Cool.
To always, sorry?
No, it's good. I think that's going to be very interesting.
It will be, yeah. It will be. So, and it's always like, okay, let's put our, let's say not money where our mouth is in this case, but let's actually use what we, I mean, of course we do this as well, but this is not like what I want to discuss right here. It is just like what kind of estimate can we get from the calculations? Again, this is the plot from the regression fit from February 2011, and based on the numbers and the PPI that we got, the estimate is like 2.4%, which is very low. It is not realistic, and the really reason is that we have all the numbers and we see that we actually like the last data points are elevated, so that's why we are working a different regime. However, when we only take the data points of this regime into consideration and do this analysis, we can calculate an estimate of 3.9, which is much higher, and I hope we don't get there, because that would mean a month-over-month number of a 0.7 or 0.8 or something like that. And that would be pretty much crashing the market.
Then you would have your external shock, this time provided by data.
Exactly by data. But we all know we have great cooks at the BLS, so they will cook the number kind of right. And anyway, so what's the best that we can do here with these fits is taking the average. The average results into 3.2%, which is lower than I would expect based on just the very low previous year number. So we won't get 3.2. And the best, let's say best case, we stay sticky. Here it's shown that we reach from 3.4% to like 3.6%. If we stay at the same month-over-month level as before. I think we had around like 0.3%, I believe. So yeah, here, 0.313% month-over-month increase with the data point for April. So this is what this results to. And then you already mentioned that the PCE is coming up, and I also prepared the same plot for the PCE here. We saw PCE was coming down. The last March number, because we get the April number tomorrow, will be or was 0.3% month over month. So the blue bar right here, which results into a year over year of 2.71%. Then with the modeling, if we stay kind of the same regime we had actually, which is good, we had a very high last year April number, which is in competition with the new report coming out tomorrow. So my expectation would be if we stay in the same regime, we will stay sticky at 2.7%, which I think should be should have like a neutral to kind of well taken market response. But however, as for CPI, we have the next 3 months for this is like the main number which comes up in June, then July and August numbers. They are again low. So if we stay elevated, the PCE we also move up, which again, similar picture like in the CPI outlook that I just discussed. And again, I did the same for the PCE with the full data point regression, and also only taking the regime that's elevated for the last 28 data points. Calculated the April, and since we are 1 month, the PCE is coming very late compared to the CPI and PPI, so we can actually get estimates for the April and also the May number. May number will again be reported end of June, I guess. And so we come up with averages for the April estimate of 2.6, which is kind of where we could end up, giving like the high previous year April number. And for then May, about 2.8 here, if you round correctly. So which follows actually kind of well what the simulated values that I have here in this chart. So this is where we will, this is our estimate, so to say, using the data that we have and the analysis we did for PCE. Any kind of questions to that, gentlemen?
No, I was just clicking through the charts again, especially core PCE. There are a lot of revisions always coming in afterwards, and they, especially in the last regime, they mostly have been to the upside, haven't they?
Oh, I didn't have a look for core PCE. I know like for Forex Factory, the calendar there has only like core PCE. I started to like investing because they always have the PCE, the core PCE, the month over month, the year over year numbers, not only for PCE but also for CPI and PPI. So they have more comprehensive like data that they provide you with. And of course, I did these charts that you see in the background for all of the PCE core and the general number for PPI, for CPI as well. So this is what we then discuss always in our like monthly team meeting or like weekly team meetings, and then also share that with our students that attended our seminar. So yeah, I didn't have a look at revisions, Thorsten.
No, it's absolutely fine. It's, well, it's a bit of a mixed bag then, yeah? Would I be daring to say we stay at that level and there's actually nothing going to happen in the meantime if the market accept that we're basically flat and don't have the super shock you mentioned on the slide earlier? Then we just have to cope with the situation. If nothing on the interest rate prediction side is changing, the market will have to deliver earnings, and the earnings season is almost over. So we could be here in a holding pattern.
Yeah, I think the best that can happen based on results, maybe I go back to the CPI because there's like a greater effect than the PC. Also, the PC is also very important and looked at by the Fed. So, but since we are talking CPI, let's go back to this slide. And also, so when we have a look at consumer price inflation and rate cut expectation, I agree the best that can happen that we are kind of sticky and on a hold for the next 3 months based on these low numbers. If we match them, great. If we get lower, that would be perfect. I'm not expecting that, given like the commodity prices that we saw the last 1 to 2 months. They still have an effect, as I've shown by the correlation. And then that pushes out the date for the first rate cut expectations. So we have like these high previous year numbers coming up. And we go down here. So this is August. That will be reported in second week of September, which means we are out September, October. So this is like right in the election phase. I mean, there will be no, based on that, if we, in the best case, match these like low numbers from the previous year, there will be no rate cut before the election. Only like end of the year, maybe. Or the Fed has to wait more until we actually get to like 1 year from now, to be honest. And so this is what the data tells me.
I mean, the way I look at this chart is, I look at your red line there, which starts 358, 354, 296, 315, and 233. What does that show me? It says, if I was at the Fed and one of their sort of PhDs came up and said, look, that's where we're going, I'd say, well, brilliant. We don't have to raise rates. We've got real interest rates at 2%. So real interest rates are 2-3% higher than actually now, 5%. You've got interest rates of 5%. You've got inflation expectations, coming down. That means we are definitely, in their language, making a difference and squeezing the economy. Perhaps we don't need to squeeze it too much because, you guys are all smart and tell me that line is definitely coming down. Perhaps I don't need to squeeze the economy that much. So, what it does show me is, and let's not forget, half the market at least is believing in this second wave of inflation happening already now, and they're all showing charts and fractals from way back when, saying that inflation has come down from 9% down to 3%, and it's going to zoom up to 6%. Surely we can't hold fixed income in that kind of environment. And if that turns out to be the case, then they're absolutely right. But on your forecasts, and when you look at what is going on with inflation, and when I look at what's going on with the money supply, they come to the same conclusion that actually inflation today is fairly kind of tame, whether it's 2.5% or 3.5%. Frankly, when you've had 9% last year, or sort of not around that time, you should be okay if you're a Fed guy, and for that reason, they may well still cut because of the other reason that we kind of brought up in this meeting, and Dawson and I have spoken about for a while now, is the side effects of having high interest rates. One, on the economy, all of the borrowing that still needs to be renewed. Secondly, for the government, where they've got a massive, interest rate bill to pay, much higher probably than their defense bill. So the consequences of having higher interest rates are much greater, in my view, than keeping them as they are. And especially when you've got an outlook of inflation stable and coming down, I mean, that's a good sign. Then why do I need to squeeze? And so you could still argue that this is, a positive outcome if things turn out the way they do, but with the caveat that as you say, that in the next few months you might get the odd hot print that sort of scares a few of the Fed guys, but I think they'll look through that in the same way that they look through the the hot prints in employment and retail sales and whatever, in their first FOMC, and then reiterated in their second FOMC. So I'm still of the view that the Fed do want to deliver on rate cuts, and I think your analysis here kind of confirms to me that the outlook, there is no second wave, at least not for now. That's a different story. Then we can start to think about Argentina and hyperinflation, all of that stuff, another day. But for now, inflation looks tame. Whatever your target is, okay, you pick 2%, okay, it's 3%.
Yeah, I think the Fed can deliver on the rate expectation as long as the US government actually can ensure stable or even like lowering energy costs. So through either own production and also like foreign policy, right? They actually need to, they need to get their shit together. So to say, they cannot allow any kind of like oil price increases or something like that, because then because this is like a more or less ideal scenario modeled with the long-term average CPI. That's where we're also getting down to around like the 2.4 that I have here over the next 12 months. Anything higher than that,
sure.
Like anything higher than this average will also like increase this curve at the end. But I agree, it is definitely like having pressure on the economy, and we see this also in consumer spending, delinquencies, and so on. So,
well, you all heard what candidate Trump said in one of his latest speeches. When he wins the election, or if did he say when or if? It's actually quite interesting. If he wins the election, he said there will be one thing: drill, baby, drill, from the first day on.
Now, that I just wanted to say that because you made the very good point about the correlation of CPI. Again, I don't get stressed by sort of relative price changes, but the correlation between CRB index and the CPI, and CRB is about 40% energy, and what is even the Biden administration? The Biden administration what has it done in the last few years? It has gone into the production of oil and gas like it's going out of style, and in doing so, they've managed to suppress the oil price. OPEC have had no chance to manipulate the oil price higher. And even with this sort of semi-war in the Middle East, there is a premium for oil, but it's not at a stupid level. And on top of that, you had Biden reducing the strategic petroleum reserves. And I think I mentioned it on our last talk. I'm hearing that he is doing it. He will do it again between now and the election. He's going to pump out another 1 million barrels a day of oil, to be confirmed. And if that were to be the case, that's an awful lot of oil that's going to come out, and that will be enough. And as you say, there's a lag of 1 or 2 months on the CRB. I think that was oil. And imagine you've got sort of 1 million barrels extra coming out per day, just from the strategic petroleum reserves, in addition to all the pumping that they're doing in America. This has to cap the inflation rate, and then you get the kind of path that you are forecasting here that would make sense. The election might get won at the pumps, in America.
Yeah, there were stickers circulating, I think 2 years ago at the pumps here in America. It was like you had the price window, right? Where you see like how much gas is, and then you had little stickers like that, and you had like Biden there, and like say, "I did it."
You see, but exactly right. He doesn't want to be blamed, and he wants to keep this thing in check. He knows that the Fed have no control over inflation because they don't understand what caused it in the first place. So he's going out there and say, "Well, I know what impacts CPI. 40% of the energy basket is oil, pump. Strategic petroleum reserve, sell. Get this price down." And I think That's what they're doing. Right. They are the drivers of low inflation. The Fed have nothing to do with it.
So that brings us great key point. So when is the next Fed meeting, and what do we have to look at or look out for until then with regard to inflation? So we have the next meeting coming up June 11 and 12. And up to then we get, as discussed, tomorrow we will get the PCE numbers. And then we have June 12th, directly in alignment with the Fed meeting, the CPI numbers. So as Jerome Powell said in one of the interviews last year, he will then, of course, get informed like right in the morning before the Fed meeting, before the statement itself goes out, about the numbers, to actually discuss it with the team in the evening of Tuesday, June 11th. Then, so this will be like extremely important, because the market, I mean, there's a lot of uncertainty, right? You don't know what the number will be, and you don't know what the Fed will say on the same day. I mean, this has like a lot of like spice and actually like some explosivity in the market. It would be just normal if the VIX actually starts to increase again towards June 12th, because there's so much uncertainty in this day.
Yeah, I agree with you. Especially everybody also knows if they don't do anything in June, that's it. That's it until the election.
So the cooks at BLS have to work very well then.
Yeah, well, or if you look in your optimistic prediction, they don't have to do anything. Huh?
But remember, it's not just the Fed that the market are watching right now. The ECB may well jump the gun in June and cut rates. Bank of England, they don't count necessarily, but if you get the ECB and the Bank of England, you've had Sweden, you've had Switzerland cut rates. I think that kind of sends a message to the market that central banks around the world, apart from Japan, want to see rates down.
So what I just said, to summarize this last slide, so I want to end here with a quote also showing kind of like my way how to act in the next months. So the quote is, "There's the plain fool who does the wrong thing at all times everywhere, but there's the Wall Street fool who thinks he must trade all the time." So this is exactly what I learned over the years, to be more patient, to act more like the crocodile Thorsten always explains his rationale by. Just like sit and let like the market come to you, and just like and that means for me waiting for like higher volatility. We see the long-term outlook that it seems like inflation will come down, just takes longer. So any kind of like short dips, I can then send volatility and like make my small gains slowly by playing exactly some option trades that Thorsten explains in his seminars and over the videos here on the channel.
Oh, by the way, a little update on the straddle I picked up. I closed out the call on the upside with a nice profit, and now even the put is running in, at least yesterday, and today it was earlier. So I'm looking forward to, at the moment, of a return of almost 20% since we mentioned it last time, right? With sleeping very well in the nights, having a long straddle on. So that helped.
Yeah, I was very close. I had a look at when VIX was 11.9, and I know where the IWM, I don't know, 207 or something like that. So I was very, very close, and then I said like, okay, let's actually see, because I had actually like a short strangle on, which was earning money for myself the last week. So yeah, I was then rather like more keen to selling options and volatility. So I was just waiting for some spikes there.
Yeah, I'm with you. I'm just waiting for the volatility to be high and to sell stuff. At the moment, it's really this. You mentioned the crocodile. A beautiful quote. Yeah, let's wait. I don't have to do all the time something. Only when it seems to make sense, and I can shift the probabilities a little bit in my direction. And as I said, I think we are at high elevated levels here. And Nic and I mentioned Mr. Buffett on the show before. And it's always the question, don't ask people for opinion. Look what they have in their books as trading positions. And he has a huge cash position at the moment. That doesn't mean everything he does is right, but it says one of the greatest investors of all times thinks there's not much value in the equity markets at the moment. Might be worth something.
Yeah. Cool. Very good. Thank you, Tim.
Tim, that was absolutely awesome. Quick question. The last time we put the presentation on our website, shall we do that this time again?
I think you can do that.
Okay, lovely. Because everybody who's interested to get a little bit deeper in, especially these marvelous slides, I'm pretty sure Nic and I will start pushing the one marvelous slide about Nic, you said it's going to get viral.
It's going to go viral. It's bloody marvelous.
I'm agreeing with you. So we will do our part to get this out. It's a fantastic analysis of how the market thinks and thought in the past and how the development is. Otherwise, I can only say thank you very much, Tim. It's like always, it's an absolute pleasure to see you working and getting all these stocks together and underpinning the so important math and statistics with just plain talking about what's going to happen. So having said all that, Tim, any last words for us?
Not that I mean, this quote says it all for me. So I don't have any kind of like very last funny words. Thank you all for your time, taking your time to discussing that. And I'm looking forward to starting some discussions in comments. Please leave a like, a comment, share that if you like it. And we are very, very interested in like getting like a very nice community together to discuss what we deal with every day.
Absolutely. So I say thank you, Nic. Thank you, Tim. That was absolutely awesome. I've learned a lot again today, as I always do. Every day, new stuff coming in. I'm appreciating that very much. And I hope our viewers will do, as Tim just said, like us, share us, comment on it. We try to get back on the comment section, and we will keep this series going. Thank you very much. Wish you all a good, successful week, and bye-bye.
Thank you, guys. Bye-bye.
Bye.